Thank you for inviting me to speak today to your webinar. As Amy said, my name is Matt Parker, and I'm an aquaculture business specialist with University of Maryland Extension. And today I'm going to go over some things to consider when you're doing aquaculture business planning. And then in another presentation by another speaker, you'll get a briefing of the financial forms that are often used for record keeping, or not necessarily record keeping, but for business planning, that the information that I'll give you today will help you fill out. As with all university extension programs, anything we do from the University of Maryland is open to anyone without regard to race, color, sex, gender identity, or expression, sexual orientation, marital status, age, national origin, political affiliation, physical or mental disability, religion, protected veteran status, genetic information, personal appearance, or any other legally protected. All right, so what we're talking about today is mostly the business of aquaculture and things that are impacting on farm, what impacts farm profitability. As I mentioned, some of the tools that are available will be discussed by other speakers later on at another date. So when we're thinking about our aquaculture business, we have to think about it as a business, not as a hobby, not as something, well, it may be fun to do, but not as a hobby, not as like a side gig. It's a business. And the big thing with that we're going to talk about is record keeping. And then we're going to go over costs associated with aquaculture production. So first, let's start thinking about aquaculture as a business. So you have a business, all right? You started a farm, you got something going. We got to think about what's our main product going to be. You may have multiple products, but one of them is probably going to do better than others, and that's going to be your main product. We have to set goals so that we can know how our business is doing. And then we are going to develop a plan to reach these goals that we have. And then you have to evaluate your business over time. You don't just write a plan and let it sit on the shelf. And then we have to adjust our plan after we've evaluated to see why or how we met the goals. If we didn't meet them, what we needed. Do we have different goals? So we need to evaluate our business periodically to know how we're doing and see if we need to make any changes. So the goals, I like to talk about SMART goals. SMART goals are specific, measurable, achievable, relevant, and then timeline, which doesn't make a nice T word, but it's talking about time-wise. So specific, do we want to increase profit? Do we want to increase production? Do we want to decrease our production costs? We have to be able to measure it. How much of a change do we want to see? It might be a percentage amount, it might be amount of money, it might be number of pounds. Is it achievable? These goals have to be realistic. If you say, I want to improve my profitability by 200% in the next 3 days, unless you're dealing drugs, that's probably not going to happen. It's not very realistic. They need to be relevant. Is the economy right for this? Right now, the economy seems to be in flux, depending on what's going on with the administration and what's going on around the world. Tariffs are an issue that come into play. Or if you need to borrow money, are the finance rates too high right now for you to make a good go of it? Things like that. Is the economy right? Or is the goal too large? This is kind of like the achievable and realistic. If it's too large of a goal, like if you say, I want to get my FCR down to 0.1, that's not realistic or relevant. It's not very, very good. If you say, I want to save money on weed whacking and you don't have any grass to weed whack, that's not a very relevant goal. And then you need some sort of timeline to achieve these goals. Some things you might be able to do in a week. Some things might be a month. Some might take a year or more to do. It depends on what that goal is and how complex it is and lots of other factors. So we need to make sure our goals are smart and it can be measured. And we evaluate it over time. And then we have to have a business plan. So you got a lot of information about your farm, where it's located, what you're growing, what your production is going to be, what system you're using, where you're going to market your plan, which Dr. Kwamina talked about marketing, where you market your products and stuff. All that goes into your business plan, and you turn it into a single document. And this helps give you a roadmap of where you've been in the past, if this is an ongoing business, and where you want to go in the future. And it's going to help you figure out what you need to do, put it down on paper so that you have that plan. And it helps others, like a financial institution, understand your business. So if you need a loan of some sort, or you need to borrow money, they need to be able to understand what you want to do and how you're going to do it, so they can evaluate you to see if you're worthy of lending to. This is not something that you write one time and you put it on your shelf. If you do this electronically on your computer, save a new version every year. Don't just go in and make changes and save it as the same file name, because then you might forget some things that happened in the past that you tried to do. So when you update it, save a new version, print a new version out, keep those old ones as archived copies so you have something to compare to and you can look at it over time. And as I said, we want to evaluate our aquaculture business periodically. Depending on what it is, it might be weekly, monthly, seasonally, or annually. It really depends on what you're growing and what kind of production schedule you have. Feeding, you probably want to pay attention to that on a weekly basis to make sure you're not overfeeding. Feed is expensive. Other things might be monthly, or if you have a product that's harvested only a part of the year, evaluate things seasonally. For example, in Maryland, most of our aquaculture oysters are harvested when the wild season is closed. So that's a 6-month period. So they can evaluate it at the end of the season to make changes for next season or see how things are going. At the very minimum, you should evaluate your business at least once a year. I would probably do it after you do your taxes. That's a good way, because then hopefully you got all your finances recorded and everything's cleared through your bank accounts and everything. Because you got to report a lot of that stuff anyway, and it will help you figure out how your business is doing. And then you want to look at your business plan and say, all right, what goals do we have for this past year? Did we meet them? Did we not? What happened? Why did we not meet our goals? If your goals were to expand your RAS facility by double this past year, but all of a sudden tariffs or something came in and made everything more expensive than what you wanted to be able to that you could afford to pay, that's something that would impact it. So write that down. That's what happened. So when you're looking back, you'll know. Did someone get sick or a key employee quit? And that kind of messed you up for a little while. Put those things in there so you'll remember them over time. Because often we think we'll remember, but we don't always remember. I did an internship on a farm. There was an outdoor flow-through system with tanks, and the farm owner's father was an electrical engineer at NASA. And they did all their own electrical work, and they figured they'd remember where all the electric lines are. Well, guess what? They forgot where a lot of the electric lines went. So anytime we wanted to dig anything, we had to cut off the power to that particular area so that the emergency aerator was going there, only those types of things, so that we would, in case we hit an electric line, we would not get shocked and zapped. Write things down. That's one of the biggest things you need to know to do. Like I said, then if we figure out how we're done, we need to make adjustments. Are our finances going in a negative direction? If that's the case, we need to make some adjustments. Are our finances going in a positive direction? If that's the case, maybe things are going well. Let's try to set some new goals or to improve on the goals we already have. Update this business plan, put these new changes, and save a new version of it. This business plan is a dynamic document. It's a living document that you update over time. You can always modify it and improve it. All right, record keeping, the bane of aquaculture people's existence, writing things down. So why do we need to keep records? I don't know about you, but I'm getting older and I can't remember things as well as I used to. So we need to be able to remember things and so we can learn from past experiences. Also, if we have records, it might help us predict future production or times when demand is higher. If you don't write down how much things cost, there's no way to figure out your cost of production, what your break-even price might be, or to calculate any profits or losses. And if you need to obtain financing, if you go into a bank and just say, I need $500,000, they're going to want to know how you're going to pay that back and want to see your finances. And if you don't have that written down or don't have that available, then they're not going to give you a loan. Like I mentioned, it might help you predict future sales. You know, if maybe you can chart some of these things out, see some trends. So you'll know when to better plan your production and take advantage of maybe when higher prices are. And if we don't write anything down, we can't evaluate the success of your farm. We just don't have anything to look back on to see if we've gone up or down or stayed the same. So there's a couple of different types of records. What I mostly deal with are financial records with farms. So these might be sales records, the total number of fish or plants or shellfish or whatever that you sold, the price received. You know, you might have different prices for different buyers, who bought it, and what product form, shell or shucked. So for oysters, you can either sell them whole in the shell, you sell them by bushels, individuals. You might have a shucking house to shuck them into pints and quarts. If you're doing fish, you know, it might be different sizes. If you have a small processing plant, it might be whole fish versus fillets, you know, anything like that. Or if you're in the bait fish business or you're stocking fish in the ponds, a lot of those go by the inch. So 6-inch fish versus 8-inch fish, you know, those types of things. And then you have your cost of supplies, our seed stock. What do our baby fish, our plants, electricity, utilities, fuel, how much you paid, and the price for each input that you have. That way you can see if prices are going up or down over time, what's going on. Do you need to look for a new supplier if prices are getting too high? We also have labor records. So the easy one is paid labor. It's easy to calculate how many hours and the payment rate or the salary, how much you pay for each person. So we have to keep track of that. And then there's unpaid labor. You need to keep track of how many hours unpaid labor, family labor, your own labor, how much they are, how many hours they worked, and estimate an hourly cost, because one day unpaid labor could turn into paid labor, and you might have to start paying someone, and you need to have an estimate of how much that would cost you and how it might impact your business. Then we have equipment purchases. This happens from time to time. What type of equipment, how much it costs, your loan information, percentage of time is devoted to the farm work, and the estimate of the useful life. And these will help you when it comes to figuring out depreciation and how much you can write on your farm finances versus your personal finances for equipment. Like if you buy a truck and you use the truck on the farm for half of the year, and the rest of the half of the year you're pulling an RV around vacationing. I don't know a fish farmer that can do that, but if they do, you can't write off of your truck and your farm for 100% of the time if it's only there for 50% of the time. The IRS will get you on it. So things like that. Useful life, how long it's going to last, that'll be how long you can do depreciation in your farm, and you should keep track of that. There's some standardized tables that you can look up for things as well. Loan and rent payments. You know, your principal amount, your interest, who you paid when, new loan balance, receipt numbers, keep track of all that type of stuff. And have a hard copy on a lot of these things as well in case your computer crashes or somebody else's computer crashes, that type of thing. Tax payments. Did you have to pay sales tax, income tax, property tax? Keep track of it, who you paid, when you paid them. Because even though everything runs pretty smoothly now, from time to time things get messed up and they might say, well, you didn't pay it. When you have a receipt and information about when you did it, then you're better off. For example, I was at home one day a couple years ago and our water got turned off. I was quite surprised because I knew that we had paid the water bill. And I called them up. They're like, well, we didn't receive your payment. And I was like, well, it was check number such and such. It was mailed on this day. And they're like, okay, well, it must have got lost in the mail or something. If you come down right now and pay us, we'll do it and we'll turn it back on and we won't charge you the reactivation fee or whatever it was. Because I had that information, I was able to save a few bucks and go down and get my water turned on that day instead of waiting for a week or two for them to make sure that I could pay bills and that kind of thing. So keep track of it. Things get lost in the mail. Sometimes computers have glitches. Sometimes you get a invoice in the mail twice. So keep track of all these types of things, and that way we'll be better off. So as we've gone over this a little bit and talked about it, I've said why you need to collect so many records. So you need to do production records and you need to do financial records. All this helps you figure out your financial position of your business, if you're profitable, cost of production, and helps you set a sales price. So now we're going to talk even more about some of these more specific costs. So when you're doing your income statement and other things that the next one of the other speakers are going to talk about, one type of cost you're going to have are variable costs. These are costs that are incurred directly as a result of your farming operation. They can go up or down depending on how your production increases or decreases. Some of them you might be able to allocate to individual ponds or individual systems or something like, you know, how many seed or fingerlings or chemicals went into a certain pond or a certain system. So you can keep track of one pond or system is doing better than the other. Some you might have to do to the whole operation. Fuel in your truck, for example, that was kind of hard to keep track on which pond it was used for. Electricity, unless you have a meter on every pond or every system, that one might have to go to the whole production operation. Labor is the same way. You can't, if some guy's out weed whacking the fence for 8 hours a day, you can't really do that one for one pond or the other and have it make any sense. So these variable costs are directly associated with your operation and you're doing production. If you don't produce anything, you don't have these costs. That's how you keep it straight. And then we have fixed costs. These don't change regardless of the amount of production that you have. They tend to be the same either like on a monthly basis or a yearly basis. Things like your loan repayments, you get that amortization schedule for loans, and then you put that in there and everything's kind of the same month to month. Your lease rentals, those are generally the same month to month. License fees are generally the same year to year. They might change a little bit, but it doesn't matter if you produce one fish or a million fish. These typically stay the same over time. And then we may have capital and investment costs. These are typically large purchases that you may use to expand your business and you need to borrow money for equipment, land, construction materials. You're eyeing that piece of property across the street because you think that it'd be good and it's just a field doing nothing now and you want to put something on it. That would be like one of these types of costs to keep track of. And then we have depreciation. This is how much your equipment loses value over time. And it's a non-cash expense. It doesn't show up in your checkbook, but it helps you kind of figure out how much you might need for replacement. So like if you buy a new car for $100,000 and you go drive it around for a week and then you want to go sell it, you don't get $100,000 back for it. You get something less because it's been used and you've used up some of the life of that car. So the easiest way to do it is straight line depreciation, where you take the purchase price divided by those years of use that I mentioned before, and that gives you an annual depreciation rate. So if we had a $100,000 piece of equipment and it was the useful life is 10 years, you could write off $10,000 of loss of value every year for 10 years. Okay. So I say I have questions now, but I also know that I'm supposed to talk about amortization schedules. So if you give me a minute, I will get that one queued up and we'll go through amortization schedules. This part hopefully is just a review for folks. So we're going to talk a little bit about amortization schedules. So what is an amortization schedule? This is the table that details a periodic payment on a loan over time. So think about if you have a house mortgage or a car payment or a car loan, they give you that piece of paper that lists out all your payments over time, and it breaks down the amount you pay on principal and the amount you pay on interest, and then the total amount of the payment. That's an amortization schedule. So it's a loan that's paid off over time. It's not like a lump sum or something like that. So that you can look at what that interest cost is going to be, which is very important if you're making large purchases and you're trying to determine if you can afford it. It's not just the $100,000 for the equipment. It's all that interest that adds up over time and being able to pay that. And if you're like, wow, at what interest rate does this make a good a point that where I can actually move forward with this purchase? You're like 10% interest on a loan. That's horrible. I'm not going to be able to make those payments. I'm not going to be able to do it, but I'd really like to have this thing. So you pay attention to the economy, what's going on, and you can figure it out on what that total cost is going to be at different interest rates. I mean, my wife almost bought a car yesterday because there was a couple of 0% interest rates for well-qualified buyers being advertised. And we're like, no, we're not buying a car right now. 0% would be the best, because then it really is just spreading out that lump sum payment over time, or lump amount over time. But that doesn't always happen, especially with business loans. So how do we calculate it? We have this nifty formula that helps us figure out how much the payment's going to be. And you can break it down. I is the interest rate, N is the number of payments that they give you, whether it's 5 years, 7 years, whatever. And you can do this around to figure out what the amount of principal is and the payment amount. For the time, you can figure out what the interest totals are. And I know everyone loves doing this math as much as I do. So what I say is use an online calculator. Here's a couple of them. You can go in, you put in the loan, you put in the how long it is, the interest rate. If you think there might be times you can make extra payments, because that will help cut the amount of interest over time. So just go in and look at the calculator, do it that way. And as you can see here, it's broken down by year, shows you the interest you pay that year, principal you pay that year, and the ending balance. So that way you'll know when these things will be paid off. Like I said, it shows here on the right, you've got a chance you can put in if you wanted to make an extra monthly payment or an extra yearly payment or an extra one-time payment, how that would impact it in your your finances and getting this thing paid off for. So let's look at this one on the left. It's a loan amount for $200,000 over 15 years. There's a monthly payment of $1,600 a month for 15 years. So you pay a total of $303,000 over that 15 years for your $200,000 piece of equipment. So you paid over $100,000 in interest. So if you can figure out playing with your loan terms and your interest rates to figure things out to see what combination will minimize that total amount of interest that you pay back is what you want to use these calculators and figure this out for. It's nice they give you a sheet when you get a loan, when you buy a house or a car or something, but it's also even better to go ahead and figure this out ahead of time, so you'll, before you go in and make the loan application, those types of things, so you have an idea of what you're going to be doing.